Let's get one thing straight. We're about to tackle a misconception that can sink your small business faster than you think. Your business is not your personal piggy bank. It's a separate entity, and treating it otherwise is a recipe for disaster. Too many owners see money in the company account, a tempting pile of funds just sitting there, and think it's theirs to spend on anything, from groceries to that new gadget they've been eyeing, swiping the business card for personal expenses, blurring the lines between what's business and what's personal, is a fast track to disaster. It might seem convenient now, but trust me, it's a dangerous game. This is the biggest lie in small business, the silent killer of countless ventures, that you can take money whenever you want, without a proper system or understanding of the consequences. Treating your LLC like an ATM, constantly withdrawing funds for personal use, can destroy your company and land you in trouble with the IRS. Audits, penalties, and even closure are all possibilities. The way you pay yourself is critical. It's not an afterthought, but a fundamental aspect of running a compliant and successful business. There are rules, processes, and real consequences for getting it wrong. Ignoring them won't make them disappear. I've seen businesses crumble because owners ignored this, thinking they could skirt the rules. It's not just about accounting, it's about discipline, setting up a system and sticking to it, and respecting your business as its own entity, a separate legal being with its own rights and responsibilities. When you set up an LLC, you created a legal shield, a barrier between your business and personal life, to protect your personal assets, your home, your savings, everything you've worked so hard for. Mixing personal and business finances pokes holes in that shield, weakening its defenses and making you vulnerable. Courts can go after your personal assets if you're not careful, if they see you're not respecting the separation. This is called piercing the corporate veil, a legal term that strikes fear into the hearts of business owners, and it's a nightmare you want to avoid. Trust me, the consequences are far-reaching and devastating. Paying yourself correctly keeps that shield strong, reinforcing the legal separation between you and your business. So let's bust this myth for good. Let's learn how to do things the right way, from the start. In this guide, we'll walk through the process, the people, and the product, giving you a comprehensive understanding, the process, how you take money out, legally and responsibly, the people, you, your partners, and the IRS, all stakeholders in this financial dance. The product, a business that's financially sound and built to last, a legacy you can be proud of. It's time to learn the truth about your LLC paycheck, to dispel the myths and embrace the realities, and build a business that's truly sustainable, one that thrives for years to come. Before you even consider paying yourself a dime, it's absolutely crucial to understand your LLC's fundamental structure. This understanding forms the bedrock of your financial operations. The IRS, in its vastness, doesn't actually have a specific dedicated tax category carved out just for LLCs. Instead, it cleverly categorizes them as either disregarded entities, which applies to single-member LLCs, or as partnerships, which is the designation for multi-member LLCs. This seemingly simple distinction is a game changer. It dramatically alters everything. It dictates the specific forms you're required to file with the IRS, the types of taxes you'll be obligated to pay, and most importantly, the permissible methods for taking money out of your business. Now let's break it down. For a single-member LLC, remember that you, as the individual, are the sole owner. In the eyes of the IRS, there's no separation. You and your business are viewed as a single entity for all tax-related purposes. Consequently, all the profits your business generates, as well as any losses it incurs, seamlessly pass through directly to your personal tax return. This financial information is then meticulously reported on Schedule C of your tax return. While the process is relatively simple, it's absolutely essential to maintain unwavering discipline in how you access and utilize company cash. Shifting gears to multi-member LLCs, the IRS adopts a different perspective, treating you and your fellow members as a partnership. In this scenario, the LLC itself is required to file Form 1065 with the IRS. Furthermore, the LLC must issue a Schedule K-1 to each individual member. This K-1 form meticulously details each member's specific share of the company's profits or losses for the tax year. Here's a key point to remember. The business itself, as an entity, does not directly pay income tax. Instead, that responsibility falls upon you and your partners, individually, based on your respective shares. Understanding your member status, whether single or multi, is the crucial starting point for navigating the financial landscape. Opting for a single-member LLC generally translates to a more direct and streamlined approach. Conversely, a multi-member LLC necessitates a well-defined agreement among members, emphasizing fairness and transparency in all dealings. To that end, your operating agreement should explicitly and unambiguously define how profits and losses are to be distributed among the members. Ignoring these fundamental differences is akin to embarking on the construction of a house without the guidance of a detailed blueprint. The foundation you lay, the materials you select, and the overall plan you follow must be perfectly aligned with your chosen structure. So, are you a lone wolf, preferring to navigate the business world solo, or are you part of a pack, collaborating with partners? That's the crucial first question you need to answer honestly. If you're flying solo, your path is generally more straightforward, but it demands a high degree of self-discipline and meticulous record-keeping. On the other hand, if you're working with partners, you absolutely need clearly defined rules, open communication channels, and a strong commitment to fairness. Fail to get this right, and you run the significant risk of creating confusion, fostering conflict among members, and ultimately descending into financial chaos. But get it right, and you'll lay a solid foundation, setting your business up for long-term success and sustainable growth. Once you know your LLC structure, you need to understand how to get paid. There are three main ways: owner's draw, guaranteed payment, and payroll. The right method depends on your LLC's tax classification. Owner's draw is common for single-member and standard multi-member LLCs, just a withdrawal of profits, not a salary, and no taxes withheld. Guaranteed payments are for multi-member LLCs, taxed as partnerships, fixed payments for work, regardless of profit, and treated as business expenses. Payroll is only for LLCs, taxed as S Corp or C Corp owners become employees, and must pay themselves a reasonable salary. Using the wrong method can lead to tax penalties and accounting chaos. Draws require discipline to set aside taxes yourself. Guaranteed payments ensure fairness among partners. Payroll adds complexity but can save on self-employment taxes if your business is big enough. Each method has rules. Follow them and you'll avoid trouble. Choose wisely based on your LLC's structure. For single-member LLCs, the owner's draw is generally the simplest and most common way to pay yourself. It's a straightforward approach that reflects the direct connection between you and your business finances. Remember, you're not an employee of your LLC, so you don't need to run payroll or issue yourself a W-2 form. The relationship is different. Instead, you simply transfer money from your business bank account to your personal bank account as needed. This is your owner's draw. It's important to understand that the draw isn't considered a business expense. It's classified as a distribution of equity, representing your share of the company's earnings. You're taxed on the business's total profit, regardless of how much you actually take out as a draw. This is a key distinction to keep in mind for tax planning. That means if your business generates a profit of $100,000, you're taxed on the entire $100,000 even if you only draw $50,000 for your personal use. The remaining profit stays within the business. Because you're not running payroll, no taxes are automatically withheld from your draw. This means you're personally responsible for paying all applicable federal, state, and self-employment taxes. It's crucial to plan for this. Self-employment tax, which covers Social Security and Medicare, amounts to 15.3% on your net earnings, up to a certain annual income limit that's set by the IRS each year. To avoid penalties, you must make estimated tax payments on a quarterly basis. Miss those deadlines, and you'll unfortunately face penalties and interest charges from the IRS. Always pay yourself via a clear and easily trackable method. Avoid using cash for owner's draws. Be sure to clearly label all transfers as owner's draw in your accounting records. It's a smart idea to open a separate savings account specifically for taxes. As a general guideline, move approximately 25 to 35% of each draw directly into that dedicated tax savings account. Resist the temptation to touch that money until it's actually time to pay your taxes. This financial discipline keeps you out of trouble with the IRS and ensures the long-term health of your business. Implementing the right process for owner's draws is what separates successful business owners from those who unfortunately end up in a financial hole due to poor planning and tax mismanagement. With partners, things get more complex. Guaranteed payments compensate members for ongoing work regardless of profit, and are defined in your operating agreement. These payments are business expenses for the LLC and taxable self-employment income for the recipient. After guaranteed payments, remaining profits are distributed based on ownership percentages. Profit distributions aren't subject to self-employment tax, only the guaranteed payments are. Clear agreements prevent disputes and ensure fairness. Always set aside taxes on guaranteed payments. The right mix of guaranteed payments and profit distributions keeps partnerships running smoothly. As your LLC grows, self-employment taxes can eat into your profits. That's when electing S Corp status can save you money. As an S Corp, you become an employee and must pay yourself a reasonable salary via payroll. The IRS requires this salary to match what someone in your role would earn elsewhere. Your salary is subject to payroll taxes, but profits left after salary can be distributed without self-employment tax. This is the key tax-saving advantage of the S Corp. S Corp status adds complexity, payroll, extra filings, but the savings can be worth it if your profits are high enough. Generally, if you're netting over $50,000, talk to your accountant about S Corp status. It's not for new or low-profit businesses. For the right business, it's a smart move to keep more of your money. 3 mistakes can destroy your business. First, mixing business and personal finances. This pierces your LLC's legal protection and puts your assets at risk. Always keep separate accounts and only use business funds for business expenses. Second, failing to plan for taxes. Owners take big draws, forget about the IRS, and scramble when tax time comes. Always set aside a portion of every payment for taxes, no exceptions. Third, not having a solid operating agreement in a multi-member LLC. This document defines roles, pay, and profit splits. Without it, disputes are inevitable and can ruin partnerships. Don't start a partnership without a clear written agreement. Avoid these mistakes and you'll protect your business and your future. Discipline and planning are your best defense. Don't let preventable errors cost you everything. Learn from others' failures. Get it right from the start. The IRS's rule is simple. If you can't prove it, it didn't happen. Proper documentation is your best defense in an audit. Every payment to yourself should have a clear, consistent paper trail. Use electronic transfers or checks labeled owner's draw or shareholder distribution. Never take cash out for personal use. Categorize transactions correctly in your accounting software. S Corp require even more documentation. Salary surveys, job descriptions, payroll records. Keep your LLC's articles and operating agreement up to date and accessible. Organized records keep you compliant and give you a clear picture of your business's health. Let's put it all together with the 3 P's: people, process, and product. People, get the right professionals. An accountant and a business banker are essential. They'll help you choose the best pay method, stay compliant, and keep your finances clean. Process. Set up a system and stick to it. Open separate business accounts, automate your pay schedule, and automate tax savings. Consistency makes your cash flow predictable and your business stable. Product. Your goal is a financially healthy business. Know your numbers. Review your profit and loss, balance sheet, and cash flow regularly. Don't take more than your business can afford. Always leave a cash cushion for the unexpected. Prioritize the health of your business first. That's how you ensure it can pay you for years to come. Simple, repeatable habits build lasting wealth. Pay yourself right, and your business will thrive. That's the truth about your LLC paycheck.